even though you've seen price movement going lower, it's only coming down to an area of fair value for the market makers to accumulate longs in an area of discount. So you're having an overlap of three things. You're looking at total range from this high to this low, or this high to this low. We're in the lower portion, or 1/3 of the range. So we're in high probability for a discount market to be in effect. You're also below the equal price point or equilibrium between the low to this high. So it's consolidating near that, but now it went below it again. So we are in an area where the market makers can buy, especially if you combine that with areas of institutional order flow. So if you're looking to buy, what would you be looking for? An area to run out below the stops. In other words, sell stops below an old low. We don't see so much of that happening here. It doesn't need to do that. It's only returning down to this down candle, which is a bullish order block. A down candle before the market moves higher, that's where market support really relies. Well, not really relies, resides in. Okay, up candles before the market drops down. That up candle is exactly where resistance is on an institutional basis. So that's where selling occurs. So when we see price action like this, we can define things in terms of fair value in relationship to how the market maker is going to perceive price. The way they value price in terms of the current range that it's trading in, the same way the algo delivers price. Where are we at in proximity to the current total range? We have a nice impulsive price swing high to low here. We are in the lower portion of that range here. We have built-in buy stops above this high here, above this high here, and we have a valuation gap, okay, a fair value gap. Market's going to want to come back up there because it spent very little time in this area. It was all down movement, all down movement. No buying was actually occurring in here. No buying was occurring in here. It was all on the sell side, one-way flows. So the market ran up into just to close in where only selling took place and no real buyers. So now when price comes back up to that level and they shoot it up there like that, that's going to make a run on stops above the swing high. And we're just going to close in the range between this up candle and this up candle here, which is a fair value gap. So when we're looking at price action, it's a couple things you need to keep in consideration. The total range you're trading in, the equilibrium price point relative to the most recent trading range high and low, and we defined several of them here. We did this high to this low, with this high and this low, and this high and this low. So we have multiple things lining up with the fact that for fair value's sake, the market has a deep discount here, and it's most likely going to trade higher. And we have reference points that we can look for where the market makers should aim, but ultimately this is the fair value gap that they wanted to get back up into. And the reason why the basis was of me calling 76.65 for the week was I want to get just below where I ultimately think it's going to go. And the level at which, if we look at the high, the low comes in at 76.75, and I want to be about 10 pips or so before the actual level I think is actually going to be hit. I want to be getting out just a little bit before that. And one more instance of the things I've talked about before it happens in the charts and why those things actually materialized in price action. So price returns back to fair value in the perspective of the market maker, not fair value in the scope of buying it. This is at a premium. Okay, remember that market efficiency paradigm I started you all with. How you perceive the marketplace is not how retail is going to see price. They're going to see this